Welcome to this monthly update. I'm Julia Lee, an equity strategist at Bell Direct. And June is the end of the financial year, and it's been a good one for the Australian share market. The benchmark ASX 200 index gaining 7%, or including dividends, that's a gain of 12%. But this unusually has been a year where the large cap stocks have outperformed. We've seen the ASX 20 gaining 9%, or including dividends, a gain of 15%, while the small cap index and the mid cap index have underperformed, unlike previous years. In terms of sector performance, it's also been a little bit unusual, and it does look like the interest rate cuts that we've started to see here in Australia have impacted on sector performance, and it has been some of those defensive high yielding areas which have outperformed. In number one spot is telecom, and that's completely the opposite to last year, where it was the worst performing sector on the market. Now this is because of Telstra, which has gained more than 40% over the last 52 weeks. Telstra has been re-rated because of its rebased, more sustainable dividend, and also a view that 5G could be good for business. Its T22 turnaround plan is also ahead of schedule, which has been helping its business. But also performing well is the technology sector, and the tech sector in the top 3 places in terms of sector performance for the last 3 years running. In fact, over the past 3 years, we've seen the technology sector gaining 74% in value, only being beat by the healthcare sector, which has managed an 84% gain over the last 3 years. But in terms of the worst performing, we have seen energy underperforming this year. So it has been one of the worst areas to be in terms of the market. But let's move on to the top performing stocks. And in first place is Nearmaps. This is a high resolution imagery company which helps in the area of architecture, construction, engineering, and also council and planning. Its growth market is, of course, the US, which is a huge market and a huge potential market for it. Its largest growth category are those US annualized contracts which are greater than $50,000. So Nearmaps, number one in this financial year. Number two is Clinuvel, which has just been included to the ASX 200 index. And in third place is Afterpay, the buy now, pay later company, which debuted in 2017 June at $2.50 and is now worth more than 10 times that amount. The worst performing stocks so include Eclipse. They've seen soft trading conditions, concerns around its balance sheet, and of course a proposed merger having fallen apart because of those weaker trading conditions. But over the last 3 months, we have seen the shares bouncing back on expectations that it will not have to do a capital raising and that things are starting to improve. We've also seen battery components still coming under pressure. So Galaxy has been one of the best shorts, but unfortunately one of the worst performers on the ASX 200. And finally, packaging company Pact Group not faring so well in this financial year. It's the largest rigid plastic manufacturer in Australia and New Zealand, and of course we are seeing a bit of a structural move away from plastic packaging. We are of course in the midst of confession season, which for the full year earnings season is in May and June for confession season, and the final reports due out in August. As companies become aware that they are not going to meet profit expectations, they need to come to the market to let the market know that they're unable to fulfill those expectations. Where do those expectations come from? Well, they can be explicit from management, either at previous results or the annual general meeting, or they can be part of consensus, which is the average of what analysts that cover that company are expecting for profitability. ASIC continuous disclosure means profit results which are 5 to 10% materially different from expectations or guidance need to be disclosed to the market, and we have seen a huge number of them coming out to the market. So during confession season, unfortunately, we've seen softer trading conditions coming through from companies like AP Eagers, Amalgamated Automotive Holdings, Avio, Blackmores, BlueScope Steel, Costa Group, CSL, Caltex, Domain, Fletcher Building, Flight Centre, Link, McMillan Shakespeare, Metcash, Main Pharma, Star, as well as Viva Energy, just to name a few. And likely we're going to see a few more coming through in the month of July as well. But a positive story has been gold prices. We've seen Aussie dollar gold reaching an all-time record high. This is on the back of a combination of higher gold prices as well as a falling Aussie dollar. That makes Aussie miners with mines in Australia particularly attractive, and I like Evolution and Newcrest Mining on the large cap scale. And if you are looking for a bit more of a speculative high risk play, then Pantoro, PNR is a stock code. They own their project, which is the 100% owned Halls Creek project in Western Australia. They're debt free and they're looking to lift production from 50,000 ounces a year to 80 to 100,000 ounces a year. Of course, July is going to be a big month because the market's expecting to see an interest rate cut from the Federal Reserve. So US interest rates are likely to fall lower, and that's likely to impact on allocation of portfolios. Having a look at some of those historical trends from 1980 onwards, and usually the first cut in the cycle means that equities performance is lackluster. Equities usually go to producing single-digit returns on average following the first rate cut. This is in contrast to the lead-up where there's usually double-digit gains. Developed markets usually outperform emerging market equities, and value initially outperforms, although on a 12-month basis, eventually starts to underperform. In terms of currencies, the US dollar is expected to be weaker, bonds are expected to be up, and surprisingly, Brent and gold do well after the first interest rate cut. So we've got lots to grapple with in the new financial year. We are still late cycle in terms of equities. I feel like I've been saying that for the last couple of years, but we're also coming up to the presidential election next year in November. So President Trump is likely to try and stimulate economic growth in the new financial year, but keeping an eye on those trade wars and the impact on global economic conditions and interest rates. And of course, we're now in a falling interest rate environment, which means real assets like property, utilities, toll roads, airports become much more attractive. And in fact, we've seen some of those assets hitting all-time record highs. This week, it's been an all-time record high for Auckland Airport's AIA, and that trend is likely to continue as interest rates continue to fall. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.